Hello, good day. I hope you are fine. The objective of this video is to integrate the various stock valuation models for analysis. At foundation level, students tend to learn various stock valuation models separately. For example, the dividend discount model, price earning multiple approach, capital asset pricing models. Does all these models derive the same fair value for a common stock? Are all these models consistent in their findings? How can we reconcile and integrate all these stock valuation models? These are questions we are going to explore in this video. Stay tuned. I present here a list of commonly used symbols for share price valuation. It is convenient to familiarize yourself with all these symbols. For example, EPS stands for earnings per share. D stands for dividend per share. Time 0 means today. Time 1 means 1 year later. G stands for growth rate. And finally, RF stands for risk-free rate. The two most common approaches used by fundamental analysts to value stocks are the dividend discount model and the multiplier approach. Can these two approaches be combined? The answer is yes, and we shall find out. For a start, let's first explore and understand what is dividend discount model and what is multiplier approach. The dividend discount model is a quantitative method used for predicting the price of a company stock. The current share price is worth the sum of all the future dividend payments discounted back to their present value. For a constant growth dividend discount model, the formula is shown as follows. Dividend can be calculated as the percentage of earnings per share paid out to shareholders. Retention rate refers to the percentage of earnings per share that is retained in the company for future investment. Therefore, dividend payout ratio is equal to 1 minus retention rate. For example, if dividend payout ratio is 60%, retention rate is 40%. As you notice from the formula, the inputs for dividend discount model include expected dividend, D1, required rate of return, R, and growth rate, G. How can we determine the appropriate discount rate and growth rate? We shall find out further in the next two slides. The capital asset pricing model, or CAPM, is a commonly used model to determine required rate of return by investors due to its simplicity and practical appeal. The CAPM provides a useful conceptual framework for linking risk and return. It is an important tool for investors to calculate the risk-adjusted discount rates. As shown in the formula of CAPM, the expected return is derived from the risk-free rate plus a risk premium. The risk premium is a compensation for investors for taking risks. Risk is measured by beta. The higher the beta, the higher the expected return by investors. How can we measure the growth rate of a company? Growth rate is subjectively determined. There is no right or wrong answer until the future reality arises. There are various methods used to forecast growth rate. For example, we can use the economic growth or industrial life cycle concept to determine the growth rate. We can also analyze the long-term historical growth rate of a company to determine its future growth rate. When I was an analyst, I even interviewed the finance managers of listed companies to understand what they have in mind about the growth potential of a company. Growth rate can also be determined mathematically by using a formula. Let's understand how to use a formula to estimate the growth rate. According to this formula, the growth rate is related to retained earnings or capital in the business, which is reinvested for sustainable future returns. This formula can help you to project a company's future growth rate by looking at how much net income the company is retaining in the business, given the earnings ability of the company. Return on equity is a measure of financial performance calculated by dividing net income with shareholders' equity. Return on equity is considered a measure of a company's profitability and how efficient it is in generating profits. The higher the ROE, the more efficient a company's management at generating income from its equity financing. If the management of the company finds growth potential within its business, they will try to retain the net income for future investment. Therefore, high retention rate is an indication of high growth rate. If the retention rate is zero, it indicates zero growth rate, and the net income is 100% returned to shareholders so that they can seek better rate of return elsewhere. For years, the multiplier approach is one of the most popular methods used by analysts to estimate a stock's value. The multiplier approach involves estimating the stock's price to earnings ratio and its expected earnings next year to determine its value. P/E ratios are commonly determined in two ways. First, historical band, and second, premium or discount to industry average. The forward P/E ratio can also be calculated by dividing current market price with expected earnings per share in year one. Recall that our learning objective is to integrate the two valuation approaches, dividend discount model and multiplier approach. I first present the constant growth dividend discount model by Gordon. Dividing both sides of the equation by next year's expected earnings, and you will get a new equation. The left-hand side of the equation is a forward P/E ratio, with price today divided by expected earnings 1 year later. On the right-hand side of the equation, the numerator is the expected dividend payout ratio. So, this equation shows that the price-earning ratio that you would be willing to pay is influenced by dividend payout ratio. Let's apply the concepts in an example. In this example, the company is an all-equity firm. You are given some data. This information can be collected from the annual report of the company or financial database. Our learning objective is to determine the PE multiplier of its common stock. Before I show you the calculation, I hope you will try first. Here is the final answer. I hope this will motivate you to try. Let's look into the detailed calculations. First, we use the dividend discount model. There are three major inputs for the dividend discount model. In order to calculate the expected dividend, I can make use of the retention rate. Given that the retention rate is 75%, the dividend payout ratio is 1 minus 75% and equal to 25%. Next, I can calculate the required rate of return using the CAPM formula, as shown here. The required rate of return is the risk-free rate of 1.5% plus beta 1.2 multiplied by expected market return of 12% minus risk-free rate of 1.5%. The growth rate can be calculated by multiplying return on equity and retention rate. The growth rate is equal to 15% multiplied by 75%, and the answer is 11.25%. Given that the earning after tax is 50 million for the previous financial year, we can forecast the expected earning after tax for the next year using the growth rate. 50 million times 1 plus growth rate of 11.25% is equal to 55.625 million. Next, I'm going to calculate the earning per share. The earning per share is calculated by the earning after tax divided by number of shares outstanding. The dividend for last year, D0, is equal to last year earning per share multiplied by dividend payout ratio of 25%. The expected earning per share for next year is equal to last year earning per share 5 times 1 plus growth rate of 11.25%. The expected dividend per share next year, D1, can be calculated by D0 of 1.25 multiplied by 1 plus growth rate of 11.25%. Finally, the share price or fair value of the common stock can be calculated using the dividend discount model, using this formula here, which is D1 of 1.39 divided by required rate of return of 14.1% minus growth rate of 11.25%, and the fair value is 48.79 ringgit. Alternatively, we can use the second method, the PE multiplier approach, to value the stock. First, we calculate the PE ratio using this formula here. The dividend payout ratio of 25% divided by R of 14.1% minus G of 11.25%, and the PE ratio is equal to 8.77 times. Next, we calculate the fair value or the share price by multiplying the PE ratio and the expected earning per share. We have 8.77 times PE ratio multiply by 5.5625, the expected earning per share, and the fair value of the common stock is 48.79 ringgit, which is equal to the fair value calculated using the dividend discount model. You can apply the theoretical concepts highlighted in this learning session in real-world example. All you need to do is to collect relevant information about dividends, earnings, growth rate, discount rate, and examine if the intrinsic value estimated is consistent between these two methodologies. This will provide valuable information about whether the PE ratio of a company is too high beyond what is justified by the dividend, earnings, and growth rate of the company. I definitely hope to compile more information from the real world and apply them in these two models. Hopefully, we can do so in future. Finally, we have come to the end of this video. If you have benefited from this educational material, please click like, share, or subscribe. Thank you. See you and goodbye.